Question 19. A small business has decided to purchase stock from a different supplier. One supplier has provided the firm with an estimate of stock prices for future orders which will be purchased on credit. So, what the supplier has said is for 1,000 units the price will be $5 per unit, but if the business buys a bulk order of 2,000 units the price will go down to $4 per unit. As it stands, the firm has a liability to the value of A, $5,000, B, $3,000, C, $8,000, or D, the firm does not have a liability at all. Let's look at the science behind the numbers. Look at option A. 1,000 units at $5 per unit is a quote that we've been given. So 5 times 1,000 would explain option A. We're also told that if there's a bulk order of 2,000 units, the price will be $4. 2,000 times 4 is $8,000. So we can explain A and C. Option B seems to be a bit nonsensical, so we're going to eliminate that straight away. Really, the only options we need to consider here are A, 5,000, C, 8,000, or D, maybe we don't have a liability at all. Let's have a look at the definition of a liability to figure this out. It says a liability must be a present obligation arising from a past event or a transaction which results in an outflow of future economic benefits. Let's apply that to the current situation. The business has approached a prospective supplier and said, can you supply us a product? And we've been given some prices. We were told one price for 1,000 units, another price for 2,000. Is there a present obligation though? There is not. The business hasn't actually made an order yet. We've just gone and got a price. If you go and get a quote in the real world from a plumber or a builder, or even from a retail shop, there's no obligation for you to buy. So therefore the first criteria of a liability has not been met. The reason why it hasn't been met is there's no past event. No money's changed hands, there's no agreement to buy, there's no contract between the parties. So that doesn't meet the legal definition of a past event. Now, the last part is, will there be an outflow of future economic benefits? In this case, there will be. At some point, the business might buy from the supplier, in which case money will be paid. But because options, or criteria 1 and 2 here aren't true, there's no obligation and no past event, there's actually no liability at all. So to answer the question, as it stands, the firm has a liability to the value of, it's actually going to be option D. The firm does not have a liability at all because there is no present obligation or no past event.